Today's Friday, August 19th. It's ratio day. I want to take a look at some of the ratios that I look at as a technician. These are not fundamental ratios, no earnings involved. These are ratios of items that trade, and they give us an idea of what is possibly going on in the stock market. This is a popular one, XLY over XLP. It's consumer discretionary divided by consumer staples. And the theory is that when this ratio is rising, consumers are more aggressive, and when this ratio is falling, the staples are doing better and they're more defensive. So what do we see here? Basically nothing. It's a flat, shaky type of chart here. There's really nothing to say other than that it's not going anywhere. So it's trendless. So in terms of consumers, not really much you can say about consumers in terms of predicting the market. There's another ratio I look at, a little more involved, but it ends up having the same meaning. So I take consumer discretionary and technology and divide that by consumer staples and healthcare. So the aggressive sectors over the defensive sectors, and it's the same story. It's really going nowhere. I wouldn't call this a breakout of a trend line or anything like that, just sideways. No information. All right, what else can we look at? Let's look at small stocks. This is the Russell 2000 ETF over the S&P 500 ETF, the spiders. No surprise, no secret, it's going up since the beginning of the year, so that's a good thing. And even with the moving averages here, you can see that it's above the major 50 and 200-day averages. You could call this a golden cross, the 50 over the 200. So small stocks beating big stocks, that's a positive for the market. And the same is true with emerging markets over more established world markets. This is the EEM ETF divided by EFA, kind of a world ETF. Same story, looks pretty good. A little worried about the momentum here. Waning momentum, possible bearish divergence. All right, other ratios I like. Let's take a look at junk bonds over high-grade corporates. It's not junk over treasuries. It's staying in the corporate bond market. And this also, not terrible. It's flat now, but above the 200-day average here. Let's even put, let me just draw it over here. Let's even put a resistance level, put that down where it belongs. So not yet a breakout. So this is something to watch if you're bullish. If it does break out, that would be a positive for the stock market. And then along those lines, I'm going to take a look at copper versus gold. This is the JJC ETN over the GLD gold ETF. What's the difference? Doesn't really matter in terms of analysis. But you can see that copper has just been going down relative to gold for quite some time. No real indication of a change here. So in terms of copper versus gold, the economy versus safe haven, safe haven is winning here. This is a negative for the stock market. I know I've recently put out some pieces about industrial metals looking better, and I do agree with that, but industrial metals are more than just copper. The other metals seem to be doing a little bit better than copper. All right, and finally, stocks versus bonds. The S&P 500 versus the AGG, which is an all market bond type of index. And it's been rallying this year, no secret, but up into a resistance area. So I don't want to say that stocks are going to beat bonds from here on in. I know bonds are starting to look a little weak. I put out a piece on interest rate sensitive areas being a little risky. So that could push this to a breakout. I don't want to speculate on that. Momentum is not that strong at the moment. All right, so these are a lot of the ratios I look at as a technician. Just to recap, nothing much in terms of consumer, no indications there. Small caps doing better. Here too, momentum is not that great. But this is an overall positive for the stock market. An overall negative would be the copper-gold ratio. And there you have it. Just a bunch of ratios that a technician can look at and just get an idea of what's going on in the stock market.